Time for Ask Annex. As always, got a question for us. You head to our website, look for the Ask tab. In the studio, Kent Halleen, an associate wealth manager. Welcome to Ask Annex.
Thank you, Danny.
And we got Matt Morzy, investment team manager. Welcome to you.
Hey, Danny.
Question number one. Thanks to your advice on the show, I'm investing my HSA. Should it mirror the allocation in the rest of my portfolio, or do I arrange some sort of specialization? My plan is to not use it immediately.
Yeah. Well, first of all, thank you for listening and starting to get invested in that HSA. That's an extremely powerful tool that we have, both from an investment standpoint and from financial planning as well, too. You know, to really give you a real detailed answer, would really love to know a little bit more about, you know, what the time frame is on that. That's something that, you know, our wealth managers like Kent really could dig into with you. You know, in terms of not using it immediately, to me, that means that you've got at least a couple of years, if not maybe 20 or 30 before you might start pulling funds out of there. Mm-hmm. In that case, you could really step up the aggressiveness there. But it really does mean a lot in terms of what that time horizon is. 2 years is definitely a lot different than 20.
Yeah, absolutely. From what I've been seeing, too, when you're looking at the HSA and the timing, or the Roth and the timing, people really like the idea of putting it into different buckets as far as the time horizon. Not only does it show that we have a plan for the money, but at that point now we're personally catering that investment to you.
Next up on Ask Annex, my elderly parents have about $150,000 sitting in a checking account due to the sale of an inherited asset. They've asked me if they should just leave it or do something else. Given their age, I'm not really sure what's the best advice. They've got retirement funds that cover living and medical expenses. I was thinking they should move it to a CD or an HYSA. However, does that make sense for them? Any other options that would be available or should be considered? Leaving it in checking seems wrong or vulnerable for fraud or scams.
So first off, looking at the HYSA, I want to touch on a high-yield savings account just so anybody listening has that context. But talking about what would be comfortable for them, and then also looking at the checking and the layer of insulation you have of putting it into a CD or a U.S. Treasury. Right now, when you're talking about the U.S. Federal Reserve thinking about lowering those rates at some point in this year, it might be the time to lock in those longer-term rates. But really sitting down and finding out what their goals are and what your situation with them is really something that you should do.
Yeah, I think a lot of it comes down to cash flow management. It definitely seems like they have enough liquidity and enough money coming in to cover their daily needs, but you still want to have some excess funds in the checking account. From there, you start to spread that out. So high-yield savings account, you probably want to have a little bit there, getting that higher interest rate. But like you said, interest rates probably will be coming down sometime this year, so those rates will come down with it. Starting to layer in the CDs, treasuries, and then investing after that and kind of layering those areas out. But yeah, from a checking account standpoint, it's really not a great idea to have a large sum of money just sitting there. You know, I'm not an expert on the fraud part of that, but from a standpoint of just trying to maximize the money that you have and be a good steward, you really do want to layer some of those things out there, get a higher yield, maybe even get some growth if you have enough that's going to get stretched out from an investing standpoint.
Similar to the HSA question, where what's the time horizon of the money and how do we start breaking that up over the year, 2 years, 3 years? What's the time frame?
Keeping the theme going, with rate cuts on the horizon, is now the time to lock in better rates by committing to CDs.
Yeah, again, it's going to really come down to what your goal is for that money and when you're going to need it. But yeah, certainly a great idea. Rates, you know, again, the market's telling us, the Federal Reserve is telling us that they're going to start to come down this year. So starting to lock in some of those, whether it's a CD or looking at a treasury, which a lot of times you might be able to get a higher yield with looking at a treasury. And if it's money that's in a taxable account, which I would assume based on the question that it is, you might get some tax savings on that as well, too. That would make that even more attractive to you.
It has been a popular thing, especially discussing what has happened over the past year, 2 years with the volatility in the market. A lot of investor fatigue, talking about wanting to lock in those rates now, has dramatically increased now that we see the Fed potentially lowering those rates.
It's Ask Annex. We'll stay with the topic. Our final question. I had some extra cash in a high-yield savings account. As CDs mature and rates drop, where would you move this money? My current portfolio, 50% equities, 40% CD, 10% bonds.
Yeah, from here, what I'd like to know is that 40% that's in the CDs right now, where did that come from? Was that all money that was in a checking or savings account, or was it previously invested someplace else? You know, the other 50% equities, 10% bonds, was that 40% of your bond portfolio and you were 50-50 mix before? If you were, likely best place is back into fixed income, get you to that true allocation that you really wanted. If it came from equities, or if this is too low of a risk tolerance for you and you actually could take 60 or 70% in equities, that's where I would want to go. Last thing on that is if you're waiting for rates to drop before you're going to make a change, it likely is too late to make a lot of those changes. If you think from a bond perspective, bond prices move in inverse to yields. So as yields drop, bond prices go up. So if you're waiting for those yields to come down before you make the move, the price of those bonds is going to go higher, and you're actually going to miss out on some of that appreciation there.
Mm-hmm. Yeah, the one thing looking at the 40% CDs and the 10% bonds, at that point now we're talking about, in my eyes, the duration of saying when do we need the liquidity and how far are we pushing this duration in that the CDs or the bonds and now the fixed income allocation overall.
Yeah.
We're going to talk about passion assets next. Kent, you were Marine for 12 years. Do you have like Marine stuff that you would consider a passion asset?
Very much so.
Yeah, so we need plans for things like that. We got a presentation coming up. We got more details on that. Kent Halleen, Associate Wealth Manager, thanks for joining us.
Great to talk to you, Jenny.
Matt Morzy, Investment Team Manager, thank you.
Thank you.